U.S. stock markets are down after U.S. President Trump threatened to slap a 10% tariff, an additional tariff on imports from 8 European countries because they oppose having America take control of Greenland. Let's get more on this from Drew Pettit. He's a U.S. equity strategist with Citi Research. Drew, thanks very much for joining us on another volatile day. It's been an interesting year, interesting start to the year so far. Thanks very much for joining us. Did you get a chance to hear the Prime Minister's speech at Davos just now, for the Canadian Prime Minister?
Yeah, just the tail end. And look, from a high level, boy, 2026 starting to feel a little bit like 2025 right now with tariffs coming back. Look, when we think about the impact on businesses around global trade, if you start adding uncertainty around trade for multinationals and big businesses, it leads to uncertainty around fundamentals. It leads to a lot of repricing in markets. We saw that last year, and we're starting to see like early little pieces of it this year. You know, our high level math on the US, for every 10% increase in overall effective tariffs, you get about $5 in potential earnings headwind. When you think about what's happening with Greenland and the European Union around tariffs right now, you know, that could be $2, $3, maybe $4 at most. So markets taking in its stride to start because it's relatively focused. But yeah, again, starting to feel a little bit like 2025 again.
How much more can the markets take this in stride before it maybe we start to see cracks, do you think?
It's funny. The one thing that's changed, look, is you have a tax bill that passed last year that is definitely a tailwind. So to us, if you're getting these impacts on fundamentals for $4 or $5, let's say, you really probably hurt the broadening thesis. It's probably going to hit the cyclicals more. I would say the aggregate market probably takes it in stride. You probably just have less upside to earnings estimates for 2026. Look, the secular trends of AI really aren't hurt by this, and that's still a major component of the U.S. markets.
So how are you treating all this as you look at 2026?
Yeah, it's funny. We're still focused on the fundamentals and the growth. This does impact the cyclical side. It affects the major multinationals, but I still want to go to places in the market where I have the highest conviction and growth. It's still the AI trade. A lot of interesting stocks there that are getting really good return from a cash perspective on all the investment in their business. And some of these inflecting names that, again, while we got tariff news, we were still probably past peak tariff uncertainty last year. So inflecting growth down in small cap and value, and then mega cap growth for kind of the AI and secular growth trade. I think pairing them together, it gets you through a lot of this noise.
Now, any concern? I mean, the Mag 7 were taking a hit today, or at least in the futures in the pre-market earlier today. I'm not sure what they're doing right now. I haven't seen some of the numbers in the last couple of minutes, but they were taking. Any concerns that people are going to start shying away from them? Are those the ones you're talking about?
You know, what's funny? It's some of them that still look really attractive. We stopped thinking about the group as a whole, as trading as one kind of big bucket. There's a lot more idiosyncrasy between them. The ones that get the best return on CapEx are really your NVIDIAs and your Microsofts stand out there. And the ones that look really reasonably priced still to us, Amazon and Meta. So again, it's going to be about idiosyncrasies up cap, especially if you get a lot of noise on the policy front.
And now from the small cap side, you're looking the value. Where are you looking? What opportunities do you see?
That's funny. In transports, you actually see a lot of opportunity in inflecting growth. So RRX, Regal Rexnord, is just a name that our industrials analyst really likes. And you see that earnings downtrend turning into finally an earnings uptrend. So that's more on the industrial side. Again, rails, another kind of part of this thesis as well, as economic activity actually hangs in and you exit, I would say, a transport recession. And then the regional and small banks in the United States, if consumer and credit holds in, those names could still be up and to the right when it comes to earnings. So a lot of opportunity in that small cap value space that trades at like a 10-turn discount to large cap growth.
And with the transport sector, you called it coming out of a recession. What gives you that confidence?
Yeah, it's funny. If you look at the bottom-up numbers from consensus and what they're modeling, you would be at almost 20% growth for a lot of small cap and value names. Transport's, going to fall into that mix as well. Even if you cut those numbers for 2026 by 10%, you still get the best earnings growth you've had in over 3 years. So to us, we don't even have to believe consensus. There's a lot of margin of safety there where we still get earnings inflecting higher. So yeah, it's having conviction, even if the street comes back on their numbers, really comfortable there.
All right. Speaking of earnings, we're into earnings season again. What are you looking at? What do you expect? And how do you think people are going to? We had that weird last quarter where we saw good returns. Everybody seemed happy with it, but the market still said no, it wasn't enough. Do you feel we'll see that again?
Yep. The one thing that has not changed, even though markets haven't really rip-roared higher in the last 3 months, valuations are still full. When we back this out, the markets for the next 5 years are pricing in like 12.5% earnings growth. That's compounded for the next 5 years. That's pretty impressive. So when you have that type of pricing in markets, it's not just about beating. We actually think beats probably 3-4%, pretty normal versus history, not as high as what we saw in Q2 and Q3. But it's all about the guidance. It's all about the forward numbers. We actually think 2026 numbers, even with some of the talk this week, our base case is still for them to move higher. So again, if you get the estimates moving higher, consensus numbers moving higher, that's really going to be the driver. There's no room to miss. You're probably not going to get huge reactions from normal beats. It's all about forward commentary. And as long as companies keep talking about margins and productivity, we think that's the path higher for the S&P 500.
Okay, we have to wrap it up there, Drew, but thanks very much for joining us.
Yeah, take care, Roger. Thank you.
Drew Pettit is a U.S. equity strategist at Citi Research.